Gary's back in 2013 with a brand new chart. This up next. Gary, welcome back and Happy New Year.
Happy New Year to you, Daniela, all at Kitco, and of course, all of our viewers.
Gary, I wish you nothing but the best in 2013, and I really hope you've come bearing some good news on the gold front here today.
I hope so too. You know, we had the announcement last week by the Federal Reserve when the FOMC minutes were released that in fact they were looking at the potential of ending the quantitative easing program at the end of 2013. And that, of course, put the metals into a tailspin. The following day, we had a pretty tepid report in terms of the jobs report. And it reminds me of a story that was told to me by a gentleman named Larry Williams. And we were doing a series of lectures overseas. And I was very young at that time. And he simply put that what he said is that as a market technician, really, we're standing on the back of the boat and we're looking at the wake that the propellers make and looking at where the boat has been by looking at the wakes, trying to forecast where the boat's going. But only the captain knows when he's going to turn the wheel. And I was reminded of that because the Federal Reserve absolutely turned the wheel 180 degrees last week.
Right, and we'll definitely be watching what the Fed will be doing closely, Gary. And most importantly, it's important to see if this will be the year of inflation.
Well, you know what? They've talked about keeping inflation low, but at the same time, we've had the grains go up phenomenally, the meats, milk products, oil. Many of the key factors that we look at in terms of inflationary indicators are up. So the data out there right now suggests that we are in a period of inflationary growth and not decline.
Gary, the other aspect I feel we really should be talking about today is the strength that the U.S. stock market has had since the start of the year and how much of a pivotal role that may be playing on the gold front.
Well, absolutely. Investors tend to put their hard-earned dollars, investment dollars, where they think they're going to get the best returns. And the stock market was hitting some record highs. I believe it was a 5-year high up till yesterday, and it's been extremely strong. So that absolutely is going to reflect in terms of overall portfolios. But one must remember, there's two things that I really look at. And the first thing is that you have the central banks right now, and they're buying gold pretty aggressively. Now, I've heard that that might be to prop up prices. I believe that they buy because they believe that there's value there, first of all. And then secondly, irregardless of an investor's portfolio, most financial advisors recommend 10 to 15% in something like gold, physical gold. So I think that there's going to always be that demand for the precious metal.
Gary, do you think that might also translate into gold stocks doing better then?
You know, I would hope so. Gold stocks have been trading on their own, and we've not seen a very, very strong correlation between moves in the precious metal and the underlying gold stocks. There are so many other variables within a gold stock that it's much harder, I believe, to predict what they're going to do. But I would imagine that if we see a sustained rally in the precious metals markets, that's going to have to spill over into the gold stocks. But as of yet, it really hasn't.
Gary, let's get to your insert now. What goodies are you bringing us today?
Well, really what I want to look at is it has been my belief that once we saw the market come down after the announcement by the Federal Reserve, we hit some very, very critical levels in terms of Fibonacci retracement levels. And those are the levels that I want to talk about in today's insert, because I had feared that if we were unable to hold those key levels, that we might be on a technical basis be indicating lower prices. Luckily, we saw the market really bounce off of these points, as I'll show our viewers in some charts today, but we were able to really bounce off of those points and move higher. And to me, that bodes very, very well for those who still have an inclination to be bullish in the precious metals markets. You know, as much as I have a bullish outlook, and I'm firmly in the belief that what we have witnessed since 2008 has been a super bull cycle. All cycles tend to have ebbs and flows and also come to an end at a certain point. And the question that we need to ask ourselves is, do we have any compelling technical evidence that in fact we have broken this long-term uptrend that we've been on? Now, certainly when we look at the market and we look at this steep angle here by going through a series of lows, and really the lows that we're looking at were starting from the bodies here, but as you can see, I'm matching them to some various lows found in the charts and just extending that line. There's no doubt that during this most recent correction, which really began last year, 2012, of course, starts right here. But we absolutely broke through that right at the beginning. Now, the other thing that we noticed is we absolutely over the last year have been trading within a defined range. 1800 at the top, we've got this flat top, and we've had this ascending bottom. And so I really believe that we're absolutely at a critical area right now. And as you can see, when we look at it through a weekly chart, you can see the potential for the market to move down. I'm still bullish because I still believe that in terms of our wave count, in Elliott wave count, we're probably coming to the tail end of a intermediate 2 and should go into an intermediate 3. But this is, without a question of a doubt, a pretty critical area. Now, from this weekly, I want to add a little bit more information, and the information that I'm looking to add is in the form of basic Fibonacci retracements. And the net result of using these multiple retracements, what I like to call Fibonacci harmonics, is as follows. I've basically added 3 Fibonacci retracement sequences, and these are the time cycles. The first one is an extremely long retracement, and that retracement is beginning at the onset, really, of this Super Bowl run, as you can see, after the market hits 1,000 and then comes back down to about 700. Right at the tail end of 2008, we're starting at just below 700 and taking it to the record top, of course, of 1920. And when we do that, the significant number I believe to look at is 1627. It's our 23% retracement of this move up. A 23% retracement down takes us to 1627. Now, the reason that I find this interesting is one thing that I look for in my research is something that I label Fibonacci harmonics. It's a variation on the way Fibonacci harmonics are classically done, but I'm looking at different ratios or different time cycles to point to the same point. So whereas the long-term retracement takes us to 1627, I've added 2 more retracement points. One from the top at 1920 down to this first bottom here at about 1520. And then secondly, we have one from the secondary top of 1800, and that's down to an equal top of about 1520. Now, when I do that, the information or the results that we get are quite interesting because 1606, 1616, 1627. These 3 numbers are from these 3 distinctly different Fibonacci ratios or sequences with different time cycles. And it is my belief that this area right here is of critical importance because if it can hold above this area, my belief at this point is that we will form some sort of a base here and move up from there. However, if we get a hard slip below this point, I think that this area has become so critically important with different time cycles really pointing to these specific locations. I think that this is a critical area that we really need to see the market hold and have it be supportive in terms of price action. Now, the last chart that I do want to look at for today's lesson is a 2-day chart. It is in Japanese average format. And what I find noteworthy or interesting is that if we take a look at this most recent move, and this is a move from the 15, 20, 30 area up to the $1,800 area, in other words, part of this triple top. If we look at a straight Fibonacci retracement of this move up, a 61% retracement takes us to 1632. I believe our low was 24, just below that, but very, very close. And when we look at this chart, you can see that this would be a logical area, at least for us to look for support on a technical basis. Now, for those of you who have enjoyed and gained knowledge from the information that I have been presenting in the chart this, as you know, we try to offer those interested in bonus or additional content that want to dive a little bit more deeply into the topic of the week. We do provide that to our subscribers as well as our Kitco listeners. And to that end, I'm putting up a picture of the front page of our website, thegoldforecast.com, and you can see I am circling this little copyright. Go ahead, go to our site, click that little logo. It will allow you to view the bonus content for this week. Again, Fibonacci retracement.
Gary, as always, thank you. So insightful and keeping with tradition. I always have to ask, is there more to come?
Absolutely. 2013 should be a great year for us traders, and there absolutely is more in store.
And just finally, just quickly, Gary, looking ahead at 2013 here, do you think we'll have a volatile next few months?
I can tell you it certainly started off that way. When I think of last year we really had a dip and a lull, a low in the market. We put out a trade signal on January 2nd and we watched the market rally up to 1,800, about almost a $200 move. This year in the same time frame, we saw the markets under pressure. I can say one thing, and that is that there is going to be points in time when we just kind of turn our heads and wonder why what we just witnessed and why it happened. I think we will see some increased volatility this year. One, we have the fiscal cliff coming up. Everyone's talked about the fact that we avoided a very, very strong congressional stalemate in the market as they came up with a solution, but that solution isn't final. They've still, A, got to work out the details, and B, although the fiscal cliff has been avoided, we have our spending limits coming to a head, and those two things, I believe, can really make this market do some actions that we might not have perceived originally.
Gary, thanks so much for your time today. We'll see you next week.
My pleasure as always. Bye-bye.
And thanks for watching this edition of Chart This with Gary Wagner. You can email me any comments or questions and use feedback at kitco.com or tweet me at Daniela Cambone. Thank you for watching.